Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Alex Matthew. All through the day, we've been bringing you updates from mutual funds across the country and what they're saying about the latest report, which is the stress test, the first of its kind stress test related to mid-cap and small-cap schemes. This was a nudge by the regulator on the back of what some felt was froth building up in the system. And to a certain extent, the attempt was to help educate the investor community about certain risks that they might have been ignoring. But there are several of these reports out there. How should you as an investor in these schemes read them? We're going to break it down point by point. And who better to explain it to you than the Chief Investment Officer of an AMC? We are in fact joined by Trideep Bhattacharya, the President and CIO Equities at Edelweiss Mutual Fund. Trideep, thank you so much for taking the time.
My pleasure.
Pleasure having you in the studio. Let's talk about the first measure, which I think has gotten the most attention, which has to do with liquidity. In fact, let's pull up the first aspect of this on the wall next to us so that Trideep can explain how this is. So this is not the original document, Trideep, that you've shared, but this is a part of that. I have represented it. So can you explain it to us?
Sure. So first of all, thank you very much for having me on your show. But let's get to the point. Basically, what we have done in the sensitivity analysis is assuming, first in this part, assuming that there is a liquidity event or there is stress building up in the market. In such circumstances, generally what we have seen is volumes kind of tend to spike up, which is why you have the 3x volumes.
Yes.
And the participation tends to be low, which is why there is a 10% participation rate. Assuming that those two conditions hold true, how long will a fund take to liquidate 50% of their holdings if it's a mid-cap fund? And how much time will it take to liquidate 25% of its holding likewise? So for mid and small cap, these two categories, this analysis was actually done. And let's say our case, if you look at it for the mid cap fund, it'll take about 2 days to liquidate 50% of the portfolio, assuming these characteristics hold true, and this much for about 1 day for 25% of the portfolio.
That's very quick, right?
Yeah.
So, and the reason I point this out is, viewers, in case you haven't seen it, there are a lot of schemes that have shown the data for this very liquidity scenario, and it's nowhere close to a single digit. In fact, for some of the schemes for the small cap category, at the 50% portfolio liquidation level, it goes up to over 20 days, in certain cases 32 days as well. So Trideep, help us understand what a good value is. Is there a good value? Is there a benchmark? Because we're talking about ultimately small caps where there are constraints with regard to liquidity.
Yeah. So first of all, this is a very good measure by the regulator to increase the transparency in the system. And to that extent, it's a welcome move. But at the same time, it could create some confusion as well. We'll probably come to that in a bit. But I think the first thing that we need to understand is, as compared to industry average, where does the fund really stack up? So if the fund is on the lower side, for instance, you would be probably on the far low on the lower side. Then as an investor, that gives you additional comfort that in a rainy day, I could get my money as soon as possible. If you're on the other extreme, that it takes about 100 days or even more than kind of meaningful amount of days to get 50% of your portfolio out, then you should consider basically that when things don't go right, will I get my money back in time? Assuming you are a big investor for a fund. So those are the two. So basically what I'm saying is, operating in and around the extremes, particularly on the as compared to average, is what the investor should be aware of, and the distributor should be aware of, that while recommending the funds or investing in these funds, where do they stack up on the liquidity spectrum? I think the middle is fine. The extreme left, which is extremely high, low liquidity, people should be careful about.
So, but and the last point on liquidity, and then we'll move to concentration.
Sure.
Do you think that the basis or this situation, this hypothetical situation, where you're seeing 25% of redemption, it's never happened in the history of the mutual fund industry, and that includes 2008.
Correct.
Is this a little too conservative?
Yeah. So this is where I was talking about the confusion earlier. So from an investor standpoint, and for the investors who are watching this show, this is a good disclosure to have, and a sensible decision making should prevail. But to really think that as an individual retail investor, can he get the money in? He'll most likely get the money out in case he wants to get it done. Even in extreme circumstances, 25% of the portfolio liquidity, particularly if you have, even if you are a 5,000 fund, happens very rarely. So, if at all. So this is this should be seen in the context of sensible analysis,
yes,
not reacting to the extremes is the point that I would say.
Yeah. So don't go out and willy-nilly sell all of your mutual fund holdings in small and mid-cap funds. But let's talk about concentration, which is the next header, and that talks about several aspects. That talks about, on the investor side, who are your biggest investors? Are you facing concentration risk as a fund there? And it also talks about the asset side. Could you talk us through that?
Sure. I think the top 10 investor category is an important metric to keep an eye on. Now let's assume that you have a fund where the top investor is about 25% of the fund value. Now it may not be a rainy day, but if that investor decides to exit at one point in time, then he would face some of the conditions that we discussed in the previous slide.
Huge redemption pressure.
Exactly. So that would create trouble. Hence, having a top 10 investor concentration of just about 1.5% is particularly good. Even I would say up to 5% is a decent number to kind of start with.
And on the asset side?
Yeah. So that's one way to think about it, which is on the investor side. Then we come to the portfolio management side, which is core of what we do. And this is where how we construct the portfolios make an impact on how much days it takes to liquidate. As you can see that, what we have achieved here is not because we hold ton of cash or we own whole bunch of large cap stocks in our portfolio. It is fairly kind of well spread across market cap, but still the ratios that you saw, which is 2 days for 50%, holds true. So it's got to do with what type of stocks that you hold in the portfolio, and that I would leave with investors is the ultimate risk management strategy. The stocks that you own ultimately decide that on a rainy day, as you can see today, is that some of the stocks are outperforming. Owning some of those stocks ultimately is the best way to manage the portfolios.
So some have said that it needs to be true to label, and therefore it has to have a certain amount of allocation, but then you have to switch it based on what you think is appropriate in the time in terms of liquidity as well.
Correct. That is true. That is true.
So, okay, so let's talk about the next one, which is volatility. Now, we have these measures which we often discuss on several shows, and we have talked about this in the past. And incidentally, even the next slide, which has to do with a valuation, we talk about several of these aspects on an ongoing basis. But how would you describe the volatility metrics that you have shared?
Yeah. Now, this is slightly technical in nature, so let me explain.
Sure.
In very simple terms, when we talk about portfolio annualized standard deviation, which is a statistical term, sorry for the uninitiated, you should see this as a measure of risk. So, and standard deviation is a measure of risk, and that tells you correspondingly how much return you should anticipate. So distributors and advisors would first look at what is the annualized standard deviation and say, okay, place it on the risk spectrum, how high it is. Ultimate, our holy grail is if we can manage the portfolio, not taking significant deviation from the index, but still outperforming the index in a meaningful way. For example, over 10 years, our mid-cap, this is of course disclosed data, our mid-cap fund has outperformance of close to 200 basis points over 10 years with managing the standard deviation in a range. So that is what we call as Sharpe ratio, one divided by the other. That a high Sharpe ratio fund is the best fund to own. And the final bit that I would come to is the beta. Now, this in a way tells investors as to where the portfolio is going to stack up better. So on days like this, a portfolio beta of less than 1 holds true in the sense that we will be probably falling lesser than the broader market.
So if the index falls by 1%, you fall by 0.9 or 0.78.
Correct. So on the days when index falls by 5%, particularly in mid cap, which happened yesterday, these numbers are particularly comforting for investors who are maybe risk averse and who think that my portfolio should fall less. So a less than 1 number is particularly good.
Okay. And not very often that you see, or rather not very often, I would say that in certain situations there are managers that choose to be more aggressive.
Correct.
And so therefore they tend to deviate on some of these measures. But the last aspect is the valuation picture. And of course, if you own an individual stock portfolio, then you're looking at this on an ongoing basis. And of course, the manager of your fund is looking at this on an ongoing basis as well. But let's break that down. In fact, if we can pull that graphic up. Let's talk about some of these aspects, right? You're talking about a trailing price to earnings, but I would think that you also look at the forward to try and gauge where these stocks are heading. So really break this out for us.
Yeah. So this still is one half of the picture till here.
Yeah.
So there are two things that we do, the price we pay and the growth that we get.
Yes.
So the one half of the equation is the price that we pay, which you can see here in terms of the valuations. Now, if you compare this with, let's say, large caps have more valuation support than mid and small caps.
Because of the way they've run over the last 1 year.
Correct. But what they don't have is the growth, which is meaningfully higher for mid and small cap as compared to that of the large cap. So as a ultimate investor, what you are trying to do is balance between the two. You don't want a very conservative portfolio, you don't want a too aggressive portfolio. And that's where a balance is achieved when you have a portfolio PE, which is more in the mid-20s overall, that is in sync with the benchmark PE overall. So if your benchmark PE is similar as that of portfolio PE, broadly you are not taking more risk than that of the benchmark, but still you are able to deliver better returns.
So, but having said that, and I see that your measures are, or your readings are more or less where you're comfortable with, there are some that have purported that there is a little bit of a stretch, if I can call it that. Some have used the word froth in the valuations. What is your own opinion in the broader market?
My sense is that within mid and small cap space, there are pockets of irrational exuberance.
Yes.
And hence, when you picked up earlier the mid-cap portfolio, or the we have with well spread, we have some part of the allocation in the large cap domain as well. So it's better to be selective in mid and small caps rather than completely ignore the segment. Because if you ignore the segment, you are ignoring basically the growth story, which is the story of India overall.
Yes, and the last part is the portfolio turnover ratio, which is how often you're churning your portfolio, correct?
Right.
So what does this tell you? Because some people have a strategy that is analytics based, that is technical based, that is quant based, that requires a higher turnover ratio.
Yeah, I think ultimately the higher the turnover, it basically increases the cost of the product that you have inherently. Because every cost, every trade that you do incurs trading costs. So the lower the number, the better it is. The simple way to think about this is basically 1 divided by this number is the average holding period of the stock that you have. So if it is 0.5, then overall I hold an average stock in the mid-cap fund for about a year. And from a mutual fund perspective, for investors who think about conviction-based investing, who think about long-term investing, this is a very good holding period to really think about. Likewise, when you have 0.26, that means we are talking about more than a year kind of holding time frame. That tells you that the bets that we are taking, we want it to, or we let it roll, or we let it play over a course of more than a year. And hence, we are not doing short-term trading-oriented behavior. So these are actually very, I would say to a certain extent, sophisticated, but very good indicator for the investor to make a more nuanced and more sophisticated decision as to which fund to go for.
Okay, closing comments on the entirety of what we've discussed today. What should an investor glean from this, and how should it affect their decision making?
Yeah, so first of all, I would say that this measure is a positive measure, given that it increases the transparency. The more we are transparent, more it increases the confidence of the investor overall. The second thing that I would say is look for the extremes. When the industry average liquidity is, let's say, X number of days, if there is a fund which is way to the left, which is very illiquid, then one should think about allocating more carefully. But otherwise, as long as we are in the middle part of the curve, or maybe like our funds that are there, which are on probably extreme positive side of the curve, the positive side till the middle is just about the way to operate.
But that has to do also with the size of portfolio.
That's also got to do with the size of the portfolio, the management style, and various different factors that go into. So this can't be the only factor based on what you could judge, but one of the factors that you should keep in mind when you are allocating portfolios as well.
Fantastic. Trideep, thank you so much for taking the time.
Pleasure.
And I hope that this clarifies a lot of the doubts that you might have had. Of course, this was breaking down Edelweiss AMC's or Edelweiss Mutual Fund's risk report, but we are going to talk about the industry as a whole and how you should read the numbers for the industry. That's coming up after a very short break. Do stay tuned. Welcome back. You're watching the Mutual Fund Show, and we have broken down the latest risk report or stress test report of a mutual fund scheme, we were in conversation with the Chief Investment Officer of Edelweiss AMC. But now let's widen the scope and talk about the industry as a whole and mid-cap and small-cap funds by and large. I'm joined now by Mohit, CEO at Moneyfront, and Kirtan Shah, who is the Managing Director at Credence Family Office. Thank you so much to the both of you, as always, for taking the time. And, you know, it's interesting. We've broken down the numbers, so let's holistically take a view. You all have looked at the numbers. I'll come to you first, Kirtan, on this. What did you make of it? Does it change your decisions at all when you're advising your clients?
Alex, thanks so much for having me. Very honestly, I don't really think these numbers are material enough in any sense. And I'll tell you why. It's because, look, these numbers are extremely conservative. There are 3 points that I really want to highlight, which I don't think are which don't give you a very practical insight on these numbers. First, how are you calculating these numbers? You are saying that you will multiply the volumes by 3 and then divide it and then take only 10% of it and then do the stress testing. Now, I'm not sure whether these numbers or the way we are looking at this is driven by anything that has been done in terms of backtesting, whether these numbers are on the volume front fruitful enough or not. Second, very importantly, I think what is important for us to understand is that when there is a stressful situation, right, is the liquidity really going to be there the way we are doing these numbers? I don't really think so. And the most important thing is that if you remove the most illiquid 20% of it, then the redemption is done on the basis of the most illiquid stocks, which means that even if I have cash or large cap in my portfolio, this calculation is assuming that I will remove or sell the most illiquid stocks first, and then I will move downwards. That's not how you practically do it, is because practically you would want to first sell out your cash, then the most liquid assets, and then the illiquid assets. So I think even if these numbers are really looked at, it does not really give you a very practical insight, in my opinion.
Okay, fair point. Mohit, some of these schemes, you know, I'll name a few. DSP, 32 days to liquidate about 50% of its small cap portfolio. Axis, if I remember correctly, 28 days, despite the fact that it has about 10% cash. And a couple of others that have elevated number of days. But do you change your investing strategy purely based on this?
Hi, Alex. Thanks for having me on this one. Look, so honestly, I concur with Kirtan on quite a number of fronts, which he was mentioning. We don't change our strategy. Look, when an investor is getting into a mid or a small cap segment, per se, they are aware of their risk profile. And in fact, it's a conscious call being taken jointly by the investor and the financial advisor that you're getting into a small cap where liquidity is tight, right? This is the riskier part of the portfolio, and investors have to be well aware of that entire thing. Now, the second point on this one is when you're looking at these numbers, just the number of days taken to liquidate 50% of the portfolio doesn't mean anything. You have to take a very holistic view on the entire data. And I'll just give you a small example out here. If you just check the composition of large cap, mid cap, and small cap holdings across all these funds, you'll get a very real life story out there. For a fund who's taking 30 odd days or 30 plus days, it is perhaps possible that he's actually being true to label. And the composition of small cap is really very high, is significantly high. And I've seen that in quite a number of cases since morning today, that people who are showing days above 30 days, they actually have very high composition in small cap, much above the 65% stipulated composition. They have almost 70, 80%. In some cases, I've seen a fund with over 90% allocation in small cap and the number of days being greater than 30, right? So if you are a true to label small cap fund, you will take more days to liquidate your portfolio. That goes without saying. On the contrary, if you are a fund who runs with 65% small cap, but have almost 35% or 30 odd percent in large caps, then obviously your portfolio is going to be more liquid, and which is very evident in the number of days which is being mentioned by some of the fund houses. So that's the second part of the story. The third part is also you have to concurrently look at the turnover ratios. If you're churning the portfolio too often very fast, that again doesn't give me enough confidence, because then you could have flipped the portfolio many times across and moved it between different market caps and hence kind of manage the days. So again, this has to be looked in a very comprehensive manner. Just the number of days doesn't tell me any story.
Got it. Just a small point then on how much exposure, and unfortunately we have to get a very quick answer from you, Kirtan. You know, if you've got over allocation, we've been speaking about this for quite some time. Perhaps at this time, because of the kind of cracks that we've seen over the last couple of days, perhaps that's because of what we're talking about right now, the stress test that might have gotten a few people a little antsy, a little wary. Should you look at reallocating right now or continue with your original allocation?
No, I think you should continue with your original allocation unless it's changed meaningfully. Let's say more than 5 or 10% of the original allocation. If that's the case, you rebalance it, or else I think you should continue. All of these things are noise over a period of time, and probably if you have 8-10 years of investment horizon, most of these things won't matter.
Anything to add, Mohit?
Concur with Kirtan on that one. I think you're getting with your risk profile into this thing. It's a known risk, right? And you have to stick with it. Number of days of liquidity, honestly, I don't think so is a big enough criteria for an investor to change his risk profile or an asset allocation.
Fantastic. And what I will also do is I'll have both the gentlemen over at some point to maybe give us a refresher on the various ratios that you need to watch out of, because those are going to be disclosed on a fortnightly basis now. So investors have more data to look at, and the advisors also at that. Thank you so much to the both of you for taking the time and for speaking to us on the Mutual Fund Show. That brings us to the end of this particular edition. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.